Hey, future millionaires, billionaires, current millionaires, billionaires, trillionaires. Um, this guy, Perbrary, this is the guy I would like to mirror my fund off of one day, as far as his pay structure goes, where you have a high dividend. I mean, you have a high watermark to hit, and if you don't hit it, then you basically don't get paid. But the guy's name is Manish Prabhari. He's like I want to say he's Indian. I'm not from India. I'm not 100% sure, but he made a big. This is just his U.S. holdings, but he made a big bet on AMR, Alpha Metallurgic Resources, which focuses on coal, which trading at 3 times earnings, and his portfolio is 80% concentrated in that one stock. So he must really love it. Just to show you the thing we're talking about here, Alpha Metallurgic Resources, PE year of 2. Of course, I'm not sure when he bought it. If I had to guess, he probably bought it. I'm not sure exactly, but the reason the price has gone up mainly is because he bought it. So um, maybe he started buying here in the 160s. I really don't know when he started, but um, this one focuses on coal. It says, I believe. Mining company produces and processing thermal coal in Virginia, West Virginia. Um, it opened 24 active mines and 8 coal preparation and loading facilities. Um, Most people hate coal. You know, they're on the green bandwagon. They want to be the tree huggers. Anyone that invests in coal is evil, and so I kind of like this. And out of my picks, I can't really call them my picks anymore if I'm copying somebody else. But in my Roth, out of my 20 companies that I picked, I took out one of them and stuck this one in there. So not a big investment, a couple $100, but something to look at. And if you had invested in this company, and in February 22nd, 2021, when it was $15, you'd be a happy camper right now. Because that's what we call a 10-bagger, guys. When you get 10 times your money. At $115, this was a 10-bagger. So there's a lot of great companies. What happens is people. Imagine if you sold Amazon when you bought Amazon at $3, and you sold it at 30, and you got 10 times, you got a 10-bagger. You missed the whole run to 3,000. Now, I'm not saying this company is going to 3,000. I have no idea, but anytime you can buy a company, a good business, trading at 2 times earnings is always a good deal, in my opinion. You get your money back in 2 years, and everything past that is profit, and maybe 3 years. But yeah, I mean, if this company grows to 10 billion, 20 billion market cap, You get your money back in 2 to 3 years. Everything past that is profit, and you could do well. And every once in a while, you might find a really good company that might compound at 30% for 40, 50 years, and here you lucky dog got your money back in 2 years, and you've had 40 years of just free money being given to you. Now, one thing that I will point out is this company is doing a lot of share buybacks. And anytime you buy back shares, you basically increase your ownership in the company without having to spend another penny. Now, they could give the money back through dividends, but another way is also cash buybacks. And a lot of times these comments, so a lot of them are stupid and don't make any sense. But every once in a while, you have some very solid investors that they have some good comments, and I like to read the comments, and typically I like to buy when everyone hates the company. So this is definitely not my norm to do something like this, to buy once a big super investor buy something and cherry pick off them. But if this is a long-term holding, if this is a 10, 20-year investment, I mean, yeah, it would have been better to get in at 130 or $16, whatever. But anytime you're buying a company at 2 times earnings, you have an expected return on your money of 50% per year. Year 1, you get 50%. Year 2, you basically gained 100% of your you got your 100% of your investment back, or maybe year 3, and then every year after that, year 4, 50%, year 5, 50%, year 6, 50%, whatever, until. I mean, I'm sure the PE is not going to stay at 2 forever. So, I mean, eventually I think the PE will probably go at a 10 to 15 maybe. And at some point in the future, years down the road. And at that point, then it might be fair value. But yeah, 2 times earnings is a steal, I believe, and you got one of the best investors in the world buying it. It's worth a look. Coal's. Maybe you're a tree hugger. Maybe you don't like coal, and that's fine. And maybe you choose not to. And when I was in the military, I used to work with a doctor, and he was against condoms. He was against birth control. He didn't believe in it, and so maybe he shouldn't invest in condom companies or birth control companies. But so if you definitely are a pure solar or wind guy and a electric vehicle kind of person, this isn't the investment for you. But I don't mind throwing a couple $100 at it and see what happens. If you net out plant, property, equipment, liabilities, etc. from balance sheet, AMR has a net gain of $550 million. Added in $175 million for current quarter gets 725 million. Current market cap using 13.7 million shares is 2.45 billion. 2.45 billion less 725 million gets down to modified estimated or enterprise value of 1.725 billion. Criminally undervalued, says Dave. This is from the Q2 second quarter report. Earnings per share, $12.16 per share. The yearly earnings per share, EPS, I think it was $75. Dividend of 50 cents per share to be suspended next quarter in favor of more buybacks, about $7 million a quarter in extra buybacks. So they're buying back their own stock at the tune of $7 million a quarter. Now, when a company buys back their own stock, either they're, number one, a complete idiot, or number two, they are very smart, and this is what Buffett does. Warren Buffett, anytime his company Berkshire Hathaway is trading at less than book value. Sorry, I misspoke. Anytime Berkshire Hathaway is trading at less than 1 times book value, they are buying back their stock, and even. And a couple years ago, I was tempted to buy it at 170. Berkshire Hathaway, BRK.B, because I can't afford the A shares, but the B shares most people can still afford. But at $170 a share, I thought Berkshire Hathaway was undervalued, and it was back then trading for less than book value. And today, the price of Berkshire Hathaway is, let me look at my phone and see, $358.35 for the B shares. So if, you bought it at 176 or whatever, you came close to a double up or whatever. I didn't buy it because if I can buy a company that I think is going to go 3x, 4x, 10x, 20x, I'd rather invest in those if I'm pretty sure that that's going to happen. But people have different risk tolerances, and so for the average person, buying Berkshire at 176 is a good deal, and getting 100% return on your money and getting a double up in like 2 years. That's really good. But anyway, buybacks so far total 850 million, 30% of the shares they bought back. Wow, outstanding shares. Imagine this is the pizza pie. There's 13 slices in the pizza pie. There used to be 14 slices. Now it's 13. And each pizza slice is a million shares. CapEx, that means capital expenditures, fell to 55 million from 74 million. How much money do you have to spend to generate that money? Do you need to buy a new tractor, a new rail car, a new forklift? That's CapEx. That's capital expenditures. No borrowing, but 62 million in letters of credit to finance equipment. Realize price of $172 a ton. This is good. This is good news, guys. I typically don't like. Um, it was funny. I think Buffett said one time that he had never bought a stock that was higher than, say like $130 or something. Of course, that's not true today, but he very rarely buys things this high. You usually buy them cheaper. But at the rate they're buying back their own stock, I mean, that's incredible. And if these guys that run this company are really great, they might think this company is worth 500, 1,000 a share. If they're buying back their stock this aggressively, they might think their stock's worth 1,000, 2,000, 3,000, 4,000. Who knows? I mean, I don't know what they're thinking, but in their mind. But unless you're a complete idiot, you're buying. The reason you buy back stock is because you believe that your company is undervalued, and when you have excess cash, you can either do several things with it. You can either reinvest that money back into the business, you can pay a dividend with it, and or you could do share buybacks, buy back your own stock. So instead of 14 million shares, there's now 13 million shares. And let's say there was 10 million shares, and you bought back a million shares out of 10. Now you're down to 9. Well, guess what? Your ownership in the company just increased 10% without you ever investing another penny into the company. So it's a great value investor's dream when you see companies doing share buybacks. Now, if you see companies that are trading at 30 times earnings or 40 times earnings and they're doing share buybacks, they're just a bunch of idiots. They're just dumb. But every now and then you have some smart people at the top leadership, and when you see companies buying back their own stock, that is a good sign. That means they're optimistic of the future. Even though everyone hates coal, they are optimistic. Now, I'm not going to say that this is a good buy-in price because you're basically buying it at the peak. If you bought it at 188, then basically would be buying at the peak. But this guy right here, this guy seen with Charlie Munger right here, this is February, and he's got 80% of his U.S. portfolio in this one stock. He's got about 20% in this CEIX. I hadn't even looked at that one yet. But if he's putting 80% of his U.S. his holdings in this one company, I expect he thinks this thing is a 5-10 bagger maybe. So even though we might got in late to the party, we could still crash the after party. I mean, yeah, it would have been nice. Maybe he got in at 134. I know when Buffett was buying Coca-Cola, he didn't buy it all at one time. He had 10, 15 traders buying 30% of the daily trading volume every day. For months. Not days, not weeks, but for months. 6 months or so. He was buying Coca-Cola every day. 30% of the volume. As you can see, the average volume is 255,000 shares traded every day. That means there's a buyer. It has to take a buyer and a seller, to complete a trade. But for the volume has basically doubled, not quite doubled, but it's gone from an average volume of 255,000 shares traded to 430,000 shares traded. But the ones I like to invest in usually are the ones that has an opposite chart of this. Maybe they were big early on, and then now they're down here and cheap, and now they are undervalued. But yeah, I mean, if you bought this thing at $13, I mean, whoo, it's not a 30 bagger like Dak was, but it could be. It was definitely a 10 bagger. Let me see. Right here was a 10 bagger. And if someone sold right here at 116, yeah, they got 10 times their money, but they lost. Buying a company or stock is a much easier decision than selling. And you can take very different paths. And anytime you buy a stock or security, whatever, call option, whatever, you should ask yourself, where am I going to sell, or what am I going to take a stop loss? Let's say it drops 20% after I buy it. Am I going to stop myself, do a stop loss, and just sell when I'm down 20%? I don't like stop losses because the pros know you have stop losses, so they'll just short the stock to wherever your stop loss is, and then they'll just rebuy it. And you're down 20%, and they're just laughing all the way to the bank at you. So yeah, I don't like stop losses. And if you know when McDonald's hamburger is worth $1 and they're selling a McDonald's hamburger tomorrow for 50 cents, I mean, selling just because the price went down 50% is stupid. If you know the value of a hamburger is $1 and it's trading for 50 cents, you're gonna back the damn truck up. You're going to be buying hamburgers for the whole damn church, for the whole damn school, for everyone you work with. You're not going to be selling at 50. You're going to be buying at 50 if you know it's worth more than 50. So now I know coal's not going to be around forever. So maybe this is a 5-10 year thing, maybe it's a 5-year thing, maybe it's a 20-year thing. I'm not saying this might be 100-year-old company or something. I don't know, but you got one of the better investors in the world investing 80% of his U.S. holdings into this company. So that's something that's when I take notice. I like when people concentrate. I like when people take big bets on certain things. That means they're very confident in this thing. The number rule of investing is to never lose money. But the way to beat the market is you can't. At some degree, some diversification is fine. Like, I like to invest in a lot of weird companies, a lot of foreign companies, a lot of very cheap companies that have a lot of bad news. Maybe they're just got a bankruptcy or might go bankrupt, and I invest in more companies because I could be 100% sure, but I could still go broke if I'm wrong. So by if you're the by spreading your risk around a little bit for me on the smaller caps, I think 5, 4, 4, 5, 10, 20, whatever you're comfortable with. Out of that bunch of 20, 2 or 3 might go bankrupt, maybe 2 or 3 don't go anywhere, maybe 5 go negative or you lose money. But you got those couple that really do well, and those will carry you. And I don't know if I mentioned in a previous video, but there was a guy, I think I did, per Bry's friend, he was, well, I don't know if he was his friend. I don't think he ever met the guy personally, but he was an Indian investor, and he basically had 2 companies that were 3% of his portfolio, and they compounded at 30% annually for like 40 years. And then when the guy died, he ended up with $4 billion, and probably $3 billion of that was in those 2 companies. So those 2 companies that were only 2 or 3% of his portfolio ended up being probably 70 or 80% of the guy's portfolio, but he never sold. So this is how you can get very rich: is buy and hold these very good companies for 30 years, 40 years, 50 years, 60 years, and you don't even have to invest any more money into them ever. Maybe you just reinvest the dividends you get. But the most important thing is just don't sell. And I've mentioned on this channel before a couple ways that there's so many different strategies. I mean, one guy, every time he got 15 or 20%, he was buying cigar butts. The leftover cigarettes on the ground. They had one free puff, and so they were dying companies, dying industries, but they had one free puff left, and I know eventually coal will be a dying industry, but I don't think it's dead yet. But anyway, this isn't financial advice. I'm not a financial advisor. I'm just trying to help people make wiser decisions with their money so they don't have to work as hard, so they can retire early, so they can spend more time with their friends and their family and their loved ones, and they don't have to, they can travel the world, and they don't have to be forced to be trapped under a 30-year mortgage or trapped in a dead-end job they hate for 30 years. Invest in some quality businesses. Make some couple good financial decisions throughout your lifetime, and let those companies do the work, the heavy lifting for you, and you should do pretty well. Anyway, thanks for listening.